Every beginner thinks stock prices move because someone important decided they should. A boardroom on Wall Street, a group of analysts, a powerful institution quietly choosing whether a company should be worth $10, $50, or $500 per share. It feels logical because prices change constantly, sometimes every second, sometimes many times per second. When numbers move that quickly, it's natural to imagine there must be a control room somewhere deciding what every company is worth. But that assumption is wrong. And here's the shock most beginners don't realize. The stock market doesn't tell you what a company is worth. It only tells you the price of the last argument someone won. Once you understand that idea, the entire market starts making a lot more sense. Because prices don't move when someone powerful makes a decision. Prices move when thousands of people disagree with each other at the exact same moment. A stock can jump 5% in minutes, not because a company suddenly became more valuable, but because buyers became more urgent than sellers. In reality, prices move because millions of people are making different decisions at the same time, reacting to different information, acting on different emotions, and competing with each other in real time. By the end of this video, you'll understand 3 things most beginners misunderstand about the market. First, why the price you see on your investing app is not always the exact price you would actually get if you tried to buy or sell right now. Second, how buyers can force a stock price higher in seconds without any executive making a decision about it. And third, why 2 intelligent investors can analyze the exact same company and still disagree completely about what that business is worth. Once you see how those forces interact, the market stops looking mysterious and starts looking like what it really is. A massive negotiation about the future. Before we begin, a quick note. This video is for education only, not financial advice. Always do your own research before investing. Now let's start with the part almost nobody explains clearly. The stock market is really just a giant auction. At its core, the stock market is not a complicated machine. It is simply a marketplace. The same structure you see at a farmer's market, an online marketplace, or a live auction. Buyers want something. Sellers want money in exchange for it. When both sides agree on a price, a trade happens. That agreement becomes the newest market price. Every stock transaction requires 2 people, a buyer and a seller. One person believes owning the shares is worth the price being offered. The other believes selling those shares is worth accepting that price. When those opinions meet and align, a transaction occurs. That moment becomes the next price the market records. But here's the important detail beginners rarely hear. The stock market doesn't operate with one buyer and one seller at a time. It operates with thousands, sometimes millions, all placing orders simultaneously. Each investor has a different reason for buying or selling, a different timeline, a different level of urgency, and those differences are exactly what cause prices to move. The order book, where prices are negotiated in real time. Every exchange runs through something called an order book. Think of it as a constantly updating list of what people are willing to pay and what others are willing to accept. On one side are buyers. Their offers are called bids. A bid is simply the highest price someone is willing to pay for a share right now. On the other side are sellers. Their offers are called asks. An ask is the lowest price someone is willing to sell for. If you could watch the order book live, you would see numbers adjusting constantly. Buyers raising bids slightly higher to secure shares. Sellers lowering asks slightly to attract buyers. The price displayed on your trading app is usually the most recent trade where a buyer and seller agreed. But here's something many beginners misunderstand. That last traded price doesn't necessarily mean you could buy or sell the stock at that exact number right now. The real price depends on the bids and asks currently waiting in the order book. And the moment those orders change, the available price changes with them. A live scene inside the market. Imagine a moment right before a company announces earnings. One investor wants to buy shares before the announcement because they believe profits will surprise the market. Another investor is buying because the stock's momentum has been rising all week, and they don't want to miss the trend. Meanwhile, one seller is taking profits after a strong run. Another seller is panicking because they're afraid the price might collapse after earnings. None of these people are thinking about the same thing. None of them share the same strategy, but together they create the next price. One buyer raises their bid slightly higher to get shares first. A seller accepts that price. A trade happens. The market records the new price. Seconds later, another buyer raises their bid again. Another seller accepts. Another trade occurs. The price moves again. From the outside, this looks like numbers flickering randomly on a screen. But underneath, it's simply human decisions colliding in real time. Why stock prices rise? Now imagine positive news appears around a company. Maybe earnings beat expectations. Maybe a new product suddenly becomes popular. Maybe investors believe the industry itself is about to grow rapidly. Suddenly, more people want to buy shares. But shares are limited, so buyers begin competing with each other. One offers $99, another offers $100, another offers $101. Each buyer raises the price slightly to make sure their order gets filled first, just like a bidding war at an auction. As the highest bids climb, the stock price rises with them. When you see a stock steadily increasing during the day, what you are really watching is demand overpowering supply. Pattern interrupt. Here is where many beginners get fooled. When a stock rises quickly, many people assume the company suddenly became more valuable. But that's rarely what's happening in the short term. Often the business itself hasn't changed at all. What changed is urgency. Buyers suddenly became more willing to pay higher prices than sellers were willing to accept before. The price moves not because value changed instantly, but because the balance between buyers and sellers changed. Why stock prices fall? Now imagine the opposite situation. Maybe earnings disappoint. Maybe economic data worries investors. Maybe rumors spread that growth might slow. Suddenly, shareholders want to sell, but there may not be enough buyers willing to purchase at the current price. So sellers begin lowering their asking price. One seller offers $99, another offers $98, another offers $97. Each seller trying to attract a buyer faster than the next. As those asks drop lower, the market price follows. Falling prices simply reflect sellers becoming more urgent than buyers. It isn't mysterious. It's supply and demand reacting to information and emotion in real time. But this raises a much bigger question. If prices move because buyers and sellers negotiate constantly, how do they decide what a company should be worth in the first place? Why does one stock trade at $5 per share while another trades at $500? Why do some companies skyrocket while others collapse? To answer that question, investors rely on a concept called intrinsic value. Intrinsic value, estimating what a business is really worth. Intrinsic value is an estimate of what a company is actually worth, based on the economic value it can generate over time. Investors analyze factors like earnings, assets, growth potential, competitive advantages, and future profitability. The idea is simple in principle. If you owned the entire company today, how much cash could it realistically generate for you over time? That expected future income determines what the business should theoretically be worth today. If the market price is below that estimate, the stock may be undervalued. If it is above that estimate, the stock might be overpriced. But here is an important reality investors must accept. Intrinsic value is not a precise number. It is an estimate. Two experienced investors can analyze the exact same company and still arrive at dramatically different conclusions about what it is worth. Because estimating the future always involves uncertainty. The most common way investors estimate value. The most widely respected valuation framework is discounted cash flow analysis, often called DCF. The idea behind DCF is built on a simple principle. Money today is worth more than money in the future. A dollar today can be invested and earn returns. Inflation also reduces purchasing power over time. So investors estimate how much cash a company might generate in the future and then discount those future dollars back into today's value. Imagine a company expected to generate $100 of free cash flow per year for several years. Using a 10% discount rate, that future cash becomes slightly less valuable today. The payment expected next year might be worth around $91 today. The year after that, perhaps $83, and the year after roughly $75. Analysts then estimate what the company could be worth beyond that forecast period, something called the terminal value. Add all those discounted numbers together and you get an estimate of the company's value today. If the company is estimated to be worth $1 billion, and it has 100 million shares outstanding, the intrinsic value would be roughly $10 per share. If the stock trades at $8, investors might see opportunity. If it trades at $12, they might see risk. But DCF depends heavily on assumptions about growth, margins, and economic conditions. Even small changes in those assumptions can dramatically change the result. The quick shortcut many investors use because DCF can be complex. Many investors use a faster method based on earnings multiples. Instead of forecasting decades of cash flow, they compare the company to similar businesses. If companies in a certain industry typically trade at 20 times earnings, and a company earns $5 per share, investors might estimate a valuation around $100 per share. But here's the part nobody tells new investors. The market does not always care about these calculations in the short term. Prices can stay above or below intrinsic value for years because expectations, fear, and excitement influence how investors interpret the future. The psychology that shapes every price. A stock price is not just math. It is math filtered through fear, greed, urgency, and storytelling. Two investors can look at the same company and still arrive at completely different conclusions. One sees massive future growth. Another sees risk. One believes a new technology will dominate the world. Another believes it is overhyped. Those beliefs shape the bids and asks entering the market. This is why markets can be mechanically efficient while still being emotionally volatile. A real market example. Consider the case of GameStop in early 2021. The company's business fundamentals had not suddenly transformed overnight. Its long-term challenges were widely known, but a surge of retail investors buying shares at the same time created an explosion of demand. Short sellers were forced to buy shares to close their positions. That additional buying pressure pushed the stock dramatically higher in a matter of days. At one point, the price increased more than 20 times within weeks. The underlying business had not changed at that speed. What changed was the balance between buyers and sellers. Urgency overwhelmed supply. This is a powerful example of how market mechanics and investor psychology can combine to create extreme price movements. Why some stocks trade far above current profits. Growth companies often trade at high prices because investors expect profits to grow dramatically in the future. Investors are not valuing what the company is today. They are valuing what it might become. When confidence grows, prices can rise quickly. When confidence disappears, those same stocks can fall just as quickly. Interest rates also play a role. When interest rates are low, bonds offer smaller returns, which can make stocks appear more attractive. This environment often pushes prices higher across the market. Why some companies are hard to value. Some companies are extremely difficult to evaluate using traditional methods. Startups. Biotechnology firms. Early-stage technology companies. Many of these businesses have little or no profit yet. Traditional valuation models may suggest very low intrinsic value, yet investors may still pay high prices if they believe a breakthrough could happen in the future. In those cases, investing becomes less about precise calculation and more about probability and belief. So, what does this all mean for investors? When you step back, stock prices are shaped by two powerful forces operating simultaneously. The first is mechanical, buyers and sellers negotiating through supply and demand in the order book. The second is fundamental, investors trying to estimate what a company might be worth over time. Sometimes fundamentals dominate, sometimes emotion dominates, but together they create the constantly shifting prices you see every day. And once you understand that dynamic, the market becomes much less mysterious. It becomes a global conversation about the future. Millions of investors expressing millions of expectations through one simple mechanism: price. If this explanation helped clarify how stock prices are actually formed, the next concept you need to understand is even more important for beginners. Why a low stock price does not mean a stock is cheap. Many new investors lose money because they misunderstand that difference. Watch that video next, because once you understand that idea, the way you look at stocks will change completely. Thanks for watching.